Have you diversified your portfolio? You've been buying a little bit of everything or a lot of something and like placing all your eggs in one basket. So stick with me, and today I'm going to tell you about how to... Okay, I'll be back. I dropped the eggs. I'll be back. Stick with me on this video. I'll be back. Oh gosh. Welcome back. Alright, it's very obvious. Never put your eggs in one basket. If you drop it, you all break. So my name is Alex Ko. Welcome back to Family Investment. Today I'm going to speak about diversifying your stocks and shares portfolio. I think this is a very important topic for myself and everyone. The reason because why I say this: we're living in 2020, we had a flash recession, stocks are looking so attractive, everybody's buying something. New beginners investors are joining in, seasoned investors are buying big time. But the problem is when I speak to a lot of people, reading the comments, and then my clients that I speak to, I notice that people are oversaturating on a specific stock or an industry. For example, a lot of people are buying a lot of oil companies. Some other people are buying lots of Carnival, EasyJet, flights, tourism industry because they're really cheap. Some people are buying lots of banks. And when I ask them, have you diversified your portfolio? And when I look through, the answer is no. That's my concern, and that's why I'm addressing this to everyone today on how I would construct and diversify my portfolio and make sure you keep the balance, so that if anything does happen, you're on a very nice, stable base platform. So let's bring the one chart that rules them all. This is a pyramid type diversification. So this is my method. This is what I've read over the years, and this is how I built upon the base. So if you look at this graph, you've got the green, the blue, the orange, and the red. And if you notice, it's a pyramid, it's a triangle. The pyramid's been invented by the Egyptians 4,000, 5,000 years ago. And that's what I want you guys to build your portfolio based upon. Okay, so let's begin with the green, the biggest base at the bottom, the green big base, the foundation of it all. Okay, it's called index and staple stocks. So when I say index, we always, when you start buying stocks, or you might be a seasoned investor, you have to buy enough index. Do not oversaturate yourself with high risk, high growth. You have to buy good quality index and also staple stocks. What's staple stocks? Staple stocks are easy. As you can see this year, people buy lots of cleaning products, people buy lots of drinks, people buy lots of food. Companies that pay great dividend, companies don't expect big growth, but during times of crisis, this company do not expect big drops either, because we still be buying these products, these companies. So how do I see? Example, let's go into example. For me, the likes of GSK, Unilever, Procter & Gamble, and then Diageo or Costco or any other food stocks that you do. Think about things that you buy in your house on a daily basis. It might even be utilities like National Grid, power supply companies, water supply companies. These are staple stocks. They pay great dividends, and also they do not grow as much, but people use them every single day. So for me, how do you see them? How do you check? So number one is dividends, payout of the dividends. They've got good cash flow. They pay consistent dividends for many, many years. Some companies like Unilever, they pay dividends over the last 20 years. At this time of my index and staple, boom, that's a screen of me flooding all the great companies out there. And if this is being placed in a month of May, so if you want to ask in future, you might be viewing this stock, leave a comment below and I might give you my suggestion of what should be a good index and staple stock. So leave in a comment below. Okay, next, moving on to the next phase, we're going to the growth stock. So if you notice that two growth stock, the blue growth and the orange growth, what difference are they? So the blue growth are basically established blue chip companies that's still in there for growth. Not as an explosive growth as they were 10, 20 years ago, but they're still growing companies. Some of them may start paying dividends, some of them may still not pay dividends. So let's go to the blue. So on the blue one, you should be aiming around about 25% holdings of this growth stock in your portfolio. Okay, companies like what? For example, you've got Disney, you've got Microsoft, and then you've got the likes of Apple. Apple I class as the slower blue growth, Apple stocks. And then in the UK, in the UK and Euro, I'll put oil companies as part of this oil stocks. They pay some dividend, they're still growing, but sometimes they're not growing. So the likes of like Total, LVMH, Louis Vuitton. LVMH is one of my favorite few as well. And so these are what I class as growth stocks. They're still growing, they're making great profit, they're innovating the technology, they're still putting in money to try to grow against the rival. They're so big to the point the multi-billion pounds company don't expect them to be the next Amazon or the next Facebook or the next Tesla, but they're still there. They're still in the race to compete with the rest, with the big brands. So this growth stocks, 25%. Do not go more than that. Try to buy good quality ones that you don't have to worry and you can sleep at night. These are growth stocks that you can sleep at night. So P ratio that I look for these stocks are between the likes of 18 to 30. Sometimes you can go a bit further, 18 to 35, because American growth stocks can be a bit more rigorous, a bit more dynamic. And yeah, so look out for these growth stocks, buy a good amount of them, 25%, and then this should complement very well if your index and staple of about 40%. Okay, so again, boom, I'm gonna give you a screen of what I think a growth stock in the month of May as I'm producing this video just now. And again, leave your comments below if you're watching this on a different period. Ask, maybe in a different region of the world, ask, and I'll give my comments, my suggestions for you. Okay, moving on to number 3 of 4, growth. Now for the orange colored growth. What is this growth? These are more exciting growth companies. These are companies that are still growing, they're still there. The likes, I can give you a good example. Don't be more than 25%. These companies can be still in there. The likes of Netflix, the likes of Amazon, they're still growing. They're not paying dividends. The P ratios are over 40. They're still out there growing. And some of these growth stocks may not even make money yet. For example, to me, it's the likes of Fiverr, the likes of Uber, the likes of Nvidia, the likes of AMD, the likes of Ocado in the UK. There are plenty of them out there. There are plenty of them still out gunning for the growth, gunning to be the next biggest company in the world. So these are the growth stocks that I like, that I monitor every day, that I buy and sell, I trade, I buy low, sell high. And if they drop again, I buy again. These are the growth stocks I like to play around with. So activities are high in this orange region. You hold 25%, but then it's a lot of trading activity in there involved. Because then again, when they grow up really quick, they do fall down as well, and then you catch it lower and then move on again. And that's why you only keep 25%. You cannot keep buying them. Make sure to take profits from these growth stocks. Different from the blue ones, normally you buy and hold for a longer term period. You don't trade them as much. Maybe occasionally once every 18 months or 2 years or 3 years. But this one I do lots of trading on this one up and down. But remember, good quality ones. P ratio will be beyond the likes of 30, 40, 50 upwards. And some of them might not even have a P ratio. They'll be making loss, but they're growing into the profit region. And that's how you see Netflix grown for the likes of $10 all the way to $500 in the last 10 years. So these growth stocks are great quality companies. Okay, so again, boom, another screen here of what I think it's a great growth stock to own, orange growth stock to own in the month of May 2020. Leave your comments below, or if you've got anything that you want to ask, where would I locate these stocks, just tell me. Okay, now for the very last important part, high risk stock. I would only put absolute maximum 10%. In my portfolio, I've only got 2 just now of super high risk stock of 10%. And I've got 2, as you all know, my big 2 are NAT and IG Group. I've done 2 separate videos and before. I don't really hold much high risk stock, super high risk, but you do need a risky stock. Regardless of what type of investor you are, you need an element of not more than 10% investment into this really high risk one, because let's say, for example, if you got £10,000, £10,000, 10% will be £1,000. You need to put £1,000 into something high risk. And if you do lose your money, you lose £1,000. You still have the remaining 90% of your holdings. You only lose 10%. So do not go over 10%. But this 10% type high risk share potentially could go double, triple, quadruple, 5 times, 10 times. So the gain offsets the loss by a huge margin. That's why you do need some element of risk in your portfolio. End of the day, it's equity, stocks and shares investing. So the other side, if you flip it around, my message I want to get across to you viewers is, if you do buy too many high risk shares meaning in the year 2020, you've been buying so much companies that have been really damaged, you're hoping for a spring return. It might be airline stock, it might be cruise stock, it might be injured bank stock, it might be retail stock that you think you'll come back. Please do class them as high risk. Please do not buy more than 10% of your overall portfolio. If you buy, let's say, if you have a portfolio of more than 50% of risk stock, if anything goes wrong like bankruptcy or default, they go defaulting, if they lose everything, you lose that 50% in your portfolio. That risk is not good enough. You have to de-risk it to a point where it's only 10%. Again, back to my example, my NAT, I know I put £10,000 in there and it's growing, but it's only within the region of 5% of my overall portfolio. So if I do risk it, but I'm hoping to double or 2.5 times the gain, I'm skipping there and I can sleep at night. I'm not going to toss and turn and worry about it. I'm going to sleep at night because I know it will eventually come back, bounce back. Who knows what the crystal ball tells me in the future, but that's how I can manage my emotion. We're only putting 10% of this really high volatility stocks. So again, boom, a couple of examples in there. You know, I put Carnival, EasyJet, a couple of HSBC. Now I put high risk stock because they're in the really high risk region. Premier Oil. So high risk stocks are companies that are not making money. They're making loss, but they're hoping to break through. You know, high risk stocks are the ones of the biomedical, biotech companies. They might have found a component to COVID-19 vaccine, and they might jump or they might go down. These are the stocks where, you know, investors on YouTube go, boom, exciting stocks, upcoming stock. Here you go. Tesla, to me, it's a high risk stock. That's why I couldn't choose between NAT or Tesla. I've only got so much money. I'm only willing to spend 10%, and there you go. Okay, so I hope you enjoyed this list, and then leave your comment below and what I would classify as a high risk stock, or what you would classify as a high risk stock. Okay, and if you notice from these 4 colors, there's two black wings at the side. What do I call them? I call them cash. You know, to be a great investor, you need cash. You need to buy the right time at great value. If the stocks fall and you've got everything invested, you cannot capture high good value stocks. So you do need cash. So these little 2 wings at the side are your base. These are the ones that will build your base, you build a foundation, make your portfolio stronger, well balanced, and then stable as well. Cash is so important. So make sure it's not just about investing, it's about how fast you can save in times like this. So cash is important. Okay, so now I've grown cash, and you can see my videos. I'm trying to sell, to stock up cash, to buy good value stocks. So that's how I go. Buy from the bottom up, sell from the top down. And that's how you keep your emotions at bay, you keep your portfolio diversified, and control your game. End of the day, it's your money, yeah? It's your hard-earned cash. You need to control it. You need to control it. Regardless of what you're buying or what you're selling, you have to keep control. And once you've got the control at hand, then you'll be a very, very good, successful investor. So that's the end. I hope you enjoyed that. Remember, please diversify your portfolio. I'm asking everyone to do that. I still do it every day myself, my wife, my kids. I review my friends, I review my clients' portfolio to make sure that they're diversified regardless of who, what company, what industry. It's great to buy. So this is very important. Thank you very much for your time. I hope you enjoyed this, and please do share with friends and family if you find this useful, and then leave your comments below, and then let's get some discussion forward, and let's all get rich. Thank you very much. I need to go tell my wife that I broke all the eggs. I'm not looking forward to it. Have a good day. Bye.